Testing. All clear?
All clear. Hello, thank you for joining. We'll begin in just a minute. Welcome to the Investor Webinar for the first quarter of 2021. I am Angela Louie, Head of Business Development at Schultze Asset Management. I am joined by members of the investment team, George Schultze, founder and managing member at Schultze Asset Management, and Gary Julian, managing director in acquisitions of Schultze Asset Management. This webinar is for investors. If you are press or media, please sign off now and contact us directly at investorrelations@samco.net. Let me share our presentation on the screen now. This presentation summarizes our views. For a more detailed and expanded description of our view, I highly encourage you to read our latest quarterly report sent to you yesterday. In this hour that we have together, we'll cover a market review and the outlook for the rest of the year. We'll talk about the trends that we see, where our portfolio returns are coming from, and answer the question, are there more returns to be gained in the near and medium term? George Schultze will talk about what distressed securities and event-driven investing really is, how we utilize risk management, and by using trade examples from our portfolio, illustrate what we do. Gary Julian will discuss our special situations strategy by way of our activities in SPACs, and we'll leave you with some key takeaways for what to expect going forward. There will be a brief Q&A at the end of the presentation, so please type your questions at any time during the presentation, and we will do our best to get to them. So let's begin. Following an outstanding year for our fund, we were up 28% net for the first quarter this year, beating both the Russell 2000 at 12% and the S&P 500 at 6% during this period. As a reminder, our fund generated 28% net last year. Our profits this quarter came from event-driven stocks, many of which were from post-distress equities, distressed loans, and warrants. The detractors for the quarter came from our portfolio hedges. Broad markets and other assets have hit record levels, and there are signs of asset bubbles building. We are seeing non-business friendly policy proposals, such as the doubling of capital gains taxes and the doubling of minimum wages. And we are monitoring for inflation risk. Monetary and fiscal policies will likely remain very accommodative as the economy continues to recover from the pandemic. This is good news for the equity markets. Here at Schultze Asset Management, we're focused on looking for absolute returns that come from unconventional ideas. And we do this by generating idiosyncratic, and event-driven gains that may be insulated from the overall markets. So the question is, how did we specifically do this in the first quarter of 2021? One of the ways we accomplish this is by sourcing new names for the portfolio that have compelling risk-return profiles. Another way is by employing strong risk management to protect our returns. And that's partly how we achieved our numbers last year and this quarter. Our fund's portfolio is cheap. The long portfolio is 5.3 total enterprise value, while the Russell 2000 is at 20.9 times total enterprise value. Looking forward, there are tremendous opportunities ahead of us, especially with post-distress firms, and George will discuss this in a bit. For the quarter, equity markets were up. Again, Russell 2000 was up 12%, S&P 500 up 6%. Turning to the fixed income market side, interest rates have started rising from record lows last summer at around 0.5% in July 2020 to 1.7% at the end of last month, at the end of March. Even at 1.7%, rates remain near lowest since the 1960s. And with rates this low, we should think about the increasing risk of inflation and asset bubbles. I will now rattle off some macro statistics. Real GDP growth at 6.4%. Unemployment, 6.0%. CPI, 2.6%. Fed funds rate, 0.3%. And importantly, very expansionary monetary and fiscal policies. So what does this mean for all of us? The US equity markets should continue to climb, fueled by economic growth and even more stimulus. On our side, we are closely monitoring the growing risk of downward retracement in stocks using various indicators. A big buildup of negative yielding debt points to a massive misallocation of capital driven by artificially depressed and record low interest rates. And lastly, we have to talk about the risk of inflation. Now, the CPI number at 2.6% is moderate, but this can be deceptive and overlook asset inflation. Stock markets and Bitcoin are at all-time highs, and prices are soaring for gas, for semiconductors, for copper, for lumber, soybean, and wheat. And there is an astounding $14 trillion of negative yielding debt. And lower yield means higher prices. Given this outlook, our team at Schultz Asset Management maintains a disciplined focus on absolute returns and seeking out unconventional ideas that will generate idiosyncratic and event-driven returns, which may be insulated from the broader markets. We also look to hedge against risks of market corrections and inflation. This is a great time to turn it over to George Schultz, who will talk more in depth about the distressed securities and event-driven investment strategy and the way we approach risk management. A brief background, George chairs our investment and strategy committees. He wrote the book, The Art of Vulture Investing, which I encourage you to check out. And before founding this firm, he worked at MD SAS, Fiduciary Partners, a fund of funds, Mayer Brown and Platt Law Firm, and Merrill Lynch. I'd also like to remind you that if you have any questions, please type them into the Q&A box, and we will get to them at the end of this presentation. George?
Thank you so much, Angela, and thank you everybody for dialing in today. Happy to give the update here on the distressed securities market generally. We have on this slide here a copy of the long-term default rates for both high yield bonds as well as leveraged loans. You can see that they're still very high, even though they've started to drop in the first quarter. Default rates right now for high yield bonds, including distressed exchanges, are close to 5.4%. But many companies that were facing distress just a few months ago have either muddled through or somehow now, some have even actually pivoted to growth. An interesting takeaway from this slide, though, is that even though the amount of distressed debt outstanding has dropped and default rates are dropping, they're still well above the long-term average of about 3.2%. As well, they're still at the third highest level among recovery cycles over the last 2 decades. So unquestionably, there's still a lot going on in distressed securities investing. We're very much focused on post-distress equities, as Angela just mentioned, both in the public and private market. And let me just give a quick review of the 3 different types of trades we make so that people understand how that fits within the cycle. Usually during periods when the default rate is rising, that's usually the best time to short sell companies. We like to focus on equities of companies that are facing bankruptcy because most of the time those equity holders get very little recovery. We'll have an example of that with Hertz in a few minutes. When the default rate is peaking, usually that's the best time to focus on buying distressed debt. And that was a good opportunity last year. The total amount of distressed debt outstanding now has dropped. But what we've tried to do with our fund is make it an all-weather fund, regardless of the cycle. And that's why we're focused now on post-distress equities. Those are equities issued by companies that were previously distressed. Most of the time, if things go really well in a restructuring, the former lenders get that new equity, and the capital structure, the balance sheet of the company in question, is deleveraged. So the debt is cleaned away, and the company really gets a fresh start on operations. So the best time to focus on those post-distress equities, public or private, is when defaults are dropping, like you see right now. And we think that opportunity set is excellent right now. By the way, Angela mentioned events. Many times, companies that are formerly distressed and now have post-distress equities can have events that help generate alpha for those post-distress equities. They can be things like M&A or special dividends or large stock buybacks that can typically be funded with new debt after a company's balance sheet has been cleansed. So just a couple more thoughts about the distressed securities universe. Looking at the bottom right chart here, which is from JP Morgan, you can see that there's still a lot of activity across multiple industries. However, energy and retail remain the busiest sectors for distress. In the energy space, the LTM last 12 months default rate is about 17% of the total, which is massive. Retail, it's about 14% of the total. And with retail, the story is obvious. There are secular trends causing retailers to go out of business and then making it very difficult for them to compete with online retailers like Amazon. In the energy space, you just have volatility in commodities. The price of oil dropped substantially last year. At one point during March, it even went negative. It's rebounded tremendously since then. Oil prices right now are at about $65 a barrel. But it's not just volatility of commodities, but it's also just excessive leverage. There's been an inordinate amount of debt issued across all these industries. And that's why if you drill down and look through the different ones, you'll see that the default rate is high for a number of industries, whether it's services or at 4%, or housing at 2.25%, or healthcare at almost 2%, and financials at 2% plus, diversified media at almost 4.5%, and cable and satellite at almost 13%. So there's really a lot of activity across multiple industries. And we're excited about that because it gives us lots of things to do, lots of companies to look at across multiple different industries. Going forward, there are also new issues. Certainly the economy has recovered a lot from COVID, and the expectation is that we'll continue recovering with extensive fiscal and monetary support. But going forward, there are new issues that are just developing. For instance, commodity inflation. That could potentially cause new distress across multiple industries. So, the space is busy, and we're really excited about the opportunity set right now. So, as we often do in these calls, we'll go through some of the top industries where we're seeing activity and distress, and what the main drivers are in alphabetical order. Just a couple of comments about some of these sectors. For instance, in airlines, last year Boeing was facing distress, and it seemed to muddle through, as we talked about. Delta and American Airlines, they recovered after getting governmental support. In the auto space, you have General Motors, which is a post-distress equity that's somewhat mature now, is doing very well and transitioning its business with the secular change you're seeing in that space. Excuse me one moment. And then other companies in the auto space like Stellantis, which emerged from the merger of Fiat and Peugeot, as well as Ford. They're seeing a lot of secular change. Other post-distress auto operators. In the casino space, Caesars was the largest bankruptcy, and it's just a couple of years out of bankruptcy right now. As a post-distress equity, it's performing very nicely. The stock, which was single digits at one point last year during the dog days of COVID, is now at about $100 a share. So quite a recovery there for that post-reorg equity. In the coal space, it's a tale of haves and have-nots. Thermal operators like Peabody are really suffering, where metallurgical coal operators like Arch and Alpha Metallurgical are doing better as the price of met coal, which is used for making steel, recovers. In the energy space, we'll talk about some examples shortly, like Chesapeake and Denbury, but there are just lots of companies, both going in and companies that have just emerged. Whiting Petroleum is another one. In financial services, you have companies like MBIA, Bank of America, and even Freddie and Fannie still in distress right now. So I won't go through the whole list, but clearly there's a lot going on in distressed investing. And just one last takeaway, actually, in the government space, Puerto Rico's bankruptcy, which is not just the government, but multiple issuers on the island of Puerto Rico. It's the largest municipal bankruptcy of all time, and it's still ongoing. But we're starting to make headway there. I think different issuers like PREPA and the Highway Authority, as well as the overall island, the government, are eventually going to emerge from bankruptcy, possibly even later this year, but more likely into the early parts of next year for some of those bankruptcies. So just to summarize on this slide, critical for success in distressed investing at this point in the cycle is experience investing long and short in distressed securities, being flexible enough to go up and down the capital structure before, during, and after distress, even late stage distress, and looking for event-driven opportunities, with formerly distressed or partially distressed companies, including with SPACs. So I think the main takeaway on this slide is really that we did really well with post-distress equities. I won't go through all the returns again. Angela highlighted them for you in the beginning. But we like to track our win-loss ratio by investment type. And you can see in the box on the right here, we did very well with post-distress equities. We did very well with distressed loans and also with distressed warrants. Somewhat unusually, we also performed pretty well with short-sold stocks, even though it was a rising market. And I think the takeaway there is, some of these positions, when you short companies headed into bankruptcy, can really have a nice event-driven return, but you have to manage the risk well. So the best performers for our fund during the first quarter were Chesapeake Energy. I'll talk about that one in a minute. Clever Leaves, which Gary will review in a few moments, as well as General Motors. And the worst performers were Hertz, one of our hedges, the iShares Russell ETF, as well as a position in the silver market, which we use as a hedge on inflation. Let's go through some examples. So Chesapeake Energy, it's actually an interesting example because we had three different types of trades with this company. First, we shorted their pre-petition stock, and in February of this year, that stock was canceled entirely for 100% gain. It really took a number of our skills to manage that well, managing the relationship with the lenders, watching the cost of borrow, managing the risk in the portfolio. But we're very happy to close out that position with 100% gain. Later, we also bought a long position in the company's distressed debt at pennies on the dollar. I think we started buying in at about 45 or 50 cents on the dollar. And through the bankruptcy plan, that debt was converted into new post-reorganization or post-distress common stock. The new ticker symbol for that equity is CHK. So by way of background, this is a low-cost operator. It's an E&P operator, exploration and production, natural gas and oil, but they've just announced that they're looking to sell a significant amount of their remaining oil reservoirs. But they're one of the largest US E&P companies. They're diversified, have a top-tier asset base. They own interest in the Marcellus Field, the Haynesville Field, the Eagle Ford Field, the Brazos Valley, and the Powder River Basin resource plays. As I said, they'll likely monetize some of their non-core assets. It's been rumored that they're looking to sell some of their oil assets for about $2 billion now after they've emerged from bankruptcy. So Chesapeake filed for bankruptcy in the middle of last year. At filing, they had about $10.1 billion of pre-petition debt. And that really, shackled them and prevented them from, effectively weathering the dual energy oil shocks we saw last year. It was a complex plan. It was heavily litigated between differing creditors. I think it really helped to be a lawyer following this through, like I am. At one point, they had I believe it was a 13-day trial with just thousands and thousands of pages of exhibits and witness testimony. But at the end of the day, the senior secured lenders got all the equity, and the company reorganized and emerged from bankruptcy in February. As I said, the old stock was canceled entirely, and that realized our short position. Lenders in the first lien credit facility, including our fund, received just over 75% of NewCo common stock, as well as a valuable opportunity to invest in the company's shares at a discounted price. So right now, the stock's trading at about $47 a share, which implies a total enterprise value to EBITDA multiple for this year of only about 3.6 times. We're very excited about the outlook for Chesapeake. They had a 50% reduction in operating costs by reducing expenses through bankruptcy. Specifically, besides reducing debt, they've renegotiated their marketing and midstream contracts, and they reduced their overall cash cost per barrel of oil equivalent by about 40%. And a final point about Chesapeake, lots of companies are thinking about and trying to enhance their ESG goals as our society evolves, as our planet evolves. And Chesapeake has a couple of interesting and noteworthy stewardship actions with ESG. They're eliminating flaring. They're reducing greenhouse gas and methane intensity emissions, and they're also focusing more and more on electric fracking. So eventually, we think this company will be investment grade rated, and we think as a company continues to generate cash flow and perform well, that it probably has about an 85% appreciation potential to maybe about $85 a share from current levels of about 47. So very exciting story. We expect events going forward, including the monetization of some of these non-core oil assets. They'll probably use the proceeds from that to pay down any remaining debt and maybe also fund a shareholder distribution, which would be a good result for shareholders as well. Let's switch here to an example of a pre-petition stock, which is a developing situation, Hertz Global Holdings. I'm sure most of you have heard about this company. It's one of the largest rental car operators in the world. So we had a loss on this position, but I think we managed the risk really well. Right now, we have a very small remaining position in Hertz, and we still think there's actually opportunity for profit, though. So as I started to say earlier with shorting, it really takes a special expertise to be able to short companies well. You have to locate, borrow, manage the relationships with the lenders, use tighter risk management, especially during times of general market appreciation and excitement, even with things like meme stocks. And you have to monitor the cost of borrow. So besides that, the fundamental analysis for short selling companies, it's almost 100% the opposite of what you look for with a good long. This company provides airport and off-airport vehicle rental and leasing services globally. They rent cars, vans, crossovers, and light trucks. They have lots of brands that most of you have heard of: Hertz, Dollar, Thrifty, Firefly, and Flexicar, and about 12,500 almost locations. But they were seriously impacted by the COVID pandemic, and they saw a sharp decline in sales. With COVID, air travel fell dramatically, and reservations dropped by 90%. Sales were down about 70%. And it wasn't just a reduction in revenues, but this company, because of the way it funds its business through asset-based lending structures, they had a double whammy in their loan covenants, and they were forced to provide additional collateral to their ABL lenders because the value of used vehicles was declining, and because of faster vehicle depreciation with the crisis. So it all came to a head in May of last year when Hertz finally filed for bankruptcy and was forced to start liquidating their fleet of rental cars. So our investment thesis with Hertz was, like almost all companies that go through bankruptcy, we expected their shareholders to see substantial dilution as well as full cancellation potentially of their existing shares. So we initiated a short. We actively managed the risk of it. Things have changed substantially since then, though. The market for rental cars has improved substantially, as has the market for used vehicles. So now, in the Hertz bankruptcy case, there are multiple bidders bidding to own this business, and it'll likely be one of the rare companies that winds up giving something to its shareholders as it comes out of bankruptcy. The company has currently, or had a plan that they had approved, which would give shareholders, pre-petition shareholders, about 60 cents a share in warrants, plus the right to purchase about, or those warrants would have translated to the right to purchase about 4% of NewCo. So it was already substantial dilution. But the company has pivoted now to a different plan. And the company, there'll likely be an auction in the next few days to decide which of the two bidders wins and takes the prize. But the competing plan that Hertz has pivoted to would give shareholders 50 cents a share in cash, plus the right to participate in a rights offering. And the rights offering value would be for up to 10% of NewCo. We estimate using Black-Scholes that value in total is about $2.25 a share with this competing plan. The stock is currently trading at about $3.91 a share. So you still have a good likely result of about 40% appreciation on short selling this stock. It's an expensive cost to borrow. So, there's still money to be made here. But clearly a developing and changing situation. I'll talk about one last example before turning it over to Gary. This is Denbury Incorporated, which is a very interesting post-reorg equity story, because this company didn't just go through distress and restructure its balance sheet, but it also has a winning strategy for in the zero carbon sector. It's an independent oil and gas company in the U.S. It has properties in Mississippi, Texas, Louisiana, Montana, North Dakota, and Wyoming. But it has a unique strategy for getting oil out of their ground. Excuse me. That strategy reduces CO2 emissions. So Denbury injects about over 3 million tons of industrial source CO2 into its reserve fields to extract oil and gas. It's the industry leader in reducing CO2 emissions and has a potential to reach full carbon neutrality later this decade. They have a project called the Cedar Creek Project, which will use 100% industrial source CO2 and produce what's called blue oil. That is the amount of CO2 that'll be permanently injected into reserves to produce oil that Denbury gets and sells to customers, will exceed the combined expected emissions of the finished products. So they're doing good by doing well. As Ben Franklin says, they're focused on blue oil. And so this company is really, it's really on the forefront of an interesting and new, exciting strategy for generating oil, for energy in a carbon neutral way. Turning to the events with Denbury, it filed for bankruptcy and emerged from restructuring in 2020. In their plan, they eliminated about $2.1 billion in debt. And with that, they were able to reduce annual interest expense by $170 million per year. The former second lien lenders received 28% of NewCo common stock, while the old note holders and stockholders received out of the money warrants. So today's enterprise value of about 2.7 billion versus projected EBITDAX of about 504 million implies an EBITDA multiple of 5.4, dropping to 3.7 for 2022. So we think that's very interestingly cheap, especially for this company that has a unique and effective approach for doing environmentally friendly things as they get oil out of the ground. They're vertically integrated, and they have a cost structure that's largely independent from the industry overall. By the way, Denbury just reported earnings this AM this morning. They had strong free cash flow in the first quarter. Their board of directors approved their Cedar Creek project, as well as a big CO2 pipeline infrastructure investment. And it's very interesting, by the way, with this carbon capture strategy. It's generally supported by government policies. In fact, in the Internal Revenue Code has a section, I believe it's section 45Q, where tax credits are provided for companies that can do environmentally friendly things with CO2. So for this company, that translates into getting a $35 per ton credit for CO2 that's used in operations, and a $50 per ton credit if they're able to store CO2. And this company really does a great job of both. So it's an interesting profit opportunity. It's a position for us. We've made strong returns on it during the first quarter, up about 80% IRR. Currently trading at about $55 a share. Our target price for Denbury is about 75, which would be over 40% appreciation from here. But just exciting. I think there's probably even more upside given that they're really in a rapid growth business right now. So let me turn the baton to Gary, and go ahead, Angela. Sorry.
I just want to remind everyone that if you have any questions, please type them into the Q&A box at any time, and we will try to get to them at the end of the presentation. Here's a little bit about Gary Julian. Gary is the Managing Director of Acquisitions at Schultze Asset Management. He has a long track record as an investment banker working on M&A deals across multiple industries. He also serves as a director of Schultze Special Purpose Acquisition Corp. Most recently, he was the CFO for Neon Air, a helicopter-served aerial experiences company. He was executive vice president for PMV Acquisition Corp, a Gabelli-sponsored SPAC. Prior to that, Gary worked at Bronson Point Management, a long-short hedge fund, and at Armor Holdings. Gary will talk about our holding in Clever Leaves, which is an ESG pure play in cannabis. Related to their ESG profile, the energy and water consumption Clever Leaves use is far less than anything in the US and Canada, given their lower capital intensive facilities, their warmer climate, sunlight access, equatorial proximity, and high elevation. This company also only used rainwater retained on site for their water needs. Gary?
Great. Thanks, Angela, and thanks for the background. And really, what we love is not only is this a great economic opportunity for shareholders, but it is a very sound ESG proposition that we're incredibly proud of to be a significant investment in our portfolio. So Clever Leaves is an investment that came about through the launch of our SPAC vehicle back in December of 2018. We raised a $138 million SPAC. It's actually our firm's first SPAC, but I've been involved in the market for a significant portion of my career. And we transacted with Clever Leaves 2 years later. So in December of 2020, so just about 6 months ago, we selected the target Clever Leaves to transact through our SPAC. That was a $205 million transaction. So who are they? Clever Leaves is a very disruptive, very low cost, one of the largest operators on the planet of medicinal and pharmaceutical grade cannabis. They operate out of 2 markets, primarily Colombia and in Portugal as well. And they focus on global medicinal markets around the world. So think of it as if you were walking into a pharmacy and going to get medicinal cannabis, if it were prescribed, which in, for example, Germany is, you have the opportunity to buy a product that is manufactured ultimately by Clever Leaves. So an exciting opportunity, big growing TAM in major markets around the world outside the United States, and something we're incredibly excited about. So a little bit for the detail, to give a sense of scale, they have 1.9 million acres of cultivation capacity in Colombia and Portugal. That makes them one of the largest operators of scale on the planet. Their unit economics are pretty much better than anyone else on the planet. They're 90% below the Canadian operators. In Canada, there is an opportunity to export cannabis. In the US, there is not that opportunity. We have very valuable, I'll say we, because I'm on the board, the company has very valuable licenses and permits, most notably an EU GMP license, which really means their products are treated like a pharmaceutical drug. So that means, very high quality, very stringent standards, and a big barrier to entry to duplicate what it is that Clever Leaves has. When we closed the transaction, the company had 80 million of cash on the balance sheet, little debt. And so the company can operate from a position of strength and play offense. As a result of the transaction, we are one of the largest shareholders of the company. We're also the largest warrant holder. We do have a board seat. I am on the board. And I think given the experience that that we have, we provide valuable corporate governance and strategic insights. In late March, the company filed its first quarter as a public company. Q4 performance showed some nice momentum. Revenue grew by 28%. The company's in an investment mode, but the EBITDA losses are reducing as revenue is scaling, and the very valuable unit economics, which what we're attracted to, continue to go down, and I think that will just expand the moat over time. I think having said all that, looking forward, the company pushed out its revenue and EBITDA profile. It was certainly a surprise to us, but I think there's good reasons for it. COVID, they operate in markets that have very tight standards, given that they're treated like a pharmaceutical or drug category. And so while still it is a push out, it's still very good growth. And so revenue expectations this year are up over 50% year over year. EBITDA losses, I think if you strip away the public company cost, will go down. And they're investing. So examples of the investments are expanding in Portugal. They're one of the top operators in Europe. They'll continue to expand that capability. That will allow them to export the product in markets in Europe. In the US, the company has a very interesting nutraceutical operation. They're launching a CBD line. That business has nothing to do with cannabis today. And what I think part of the theme is not just the big TAM, significant scale and low, very low cost serving a high barrier to entry pharmaceutical focused operation, but we're also seeing strategic interest from investment and players outside in the cannabis market, but outside the US and outside of Canada. So for example, a US operator called Curaleaf purchased EMAC, which is one of the larger European operators. That transaction closed in April. And we've seen another SPAC transact with one of the largest Israeli operators, a company called Canndoc. That was a $400 million transaction. So our view is over time, as we expect Clever Leaves to execute on the strategy, I think we'll find strategic interest in this company, whether or not it's a cannabis operator or a pharmaceutical or drug operator. And I think that creating great opportunity for us and our shareholders. And so I think that's basically the summary of Clever Leaves. It creates a great opportunity for us to leverage our existing platform to identify very interesting, exciting transactions within an area of expertise that we have, which is in stress and distressed. I should say, because it's public, we are on file with our second SPAC vehicle to raise $200 million at this point in time. So with that, I'll pass the baton back.
Oh, we can't hear you, Angela.
Great, thank you, Gary. So let's spend some time to talk about some key points. Our fund performed well in its last quarter at 28% net. These gains came from both the long and short sides of the portfolio. We see time-pressing investment opportunities in the distressed securities and special situations space still to come. We believe risk management and investment management are two sides of the same coin, and our edge includes our deep research orientation, which is also what is driving the idiosyncratic and event-driven returns. There are new event-driven deals in the near term, and together with our investors, we celebrate our 23rd anniversary. This is our track record for our fund. You'll see that we have nearly 30 years of track record. We've seen all kinds of market conditions. You can see that we are building momentum and gains in our portfolio, which is continuing well into this year. As we discussed, we have some time-pressing opportunities that will generate returns for the remainder of 2021, and we feel strongly that our research-heavy orientation is what will best capitalize in this new environment. Going forward, our focus on investment diligence, our innovative portfolio construction, and our discipline to our process will position us best in this environment. So let's take some time now to answer some of your questions. I'm going to bring Gary and bring George back on. Hi, Gary. Hi, George.
Hi.
Let me just get ourselves all lined up. Great. So here's our first question from an existing investor. George, this is for you. How do you approach research, and how detailed can it get?
It can get very detailed. And some of our investments are very short. They may last just a few months or a few days even. Some can last more than 10 years. So we really can get to know companies really well. Just thinking about the life cycle of an investment, that we start with an idea. And we have a database of about 4,000 companies that are in and around bankruptcy and distress in general. Once we get an idea, and sometimes those ideas come from advisory board members or professionals that we've worked with in the past. Sometimes we get them just from reading through bankruptcy documents. Once we get it, though, we put that company through a standardized valuation template. And from there, as you know very well, Angela, we discuss these ideas in our weekly investment committee meetings. We look for unanimous agreement on putting any new investment into the portfolio, whether it's a buy or sell decision. And that's where analysis sort of starts and keeps going. A starter position in our portfolio is about 50 basis points. We can take and from there write a full research report on material positions. So that'll be usually a 10 to 15 pager with a full valuation model, which includes discounted cash flow analysis, segment analysis, projections, multiple scenarios and stress testing, as well as peer group review and overall positioning analysis. Once a position starts in the portfolio, then risk management kicks in. We update positions at a minimum of one time per quarter. And with each update, whether it's because of a quarterly earnings release or some other event, or because of just a big move in the position, we'll discuss it again in the investment committee meetings, which occur every Friday morning at our company. But we're looking for events, and besides attractive valuation metrics, we're looking for events that may drive that company's securities closer to fair value. We're looking for management teams on the long side, management teams that own the same securities that we own or want to own. And if the company is truly distressed, we're also digging into the bankruptcy dynamic, as I like to call it. What's going on in the plan, restructuring, negotiations. Are there things like with Hertz, for example? Is there an auction that's looming? Do we know some of the players, and how does that give us an edge or knowledge of how things might develop going forward. So that's kind of a quick overview. We can give a lot more detail if people want. We have a DDQ book that can walk you through these steps, and we'd certainly be open to discussing the process with people if they have an interest.
I have a question from the audience from a gentleman, Carl. If this doesn't disrupt the flow of things, he'd like to ask it over himself. So I'm going to try to allow. Let me see if I can do this. Carl, can you hear us?
I think you're on mute, Carl.
Yeah, he's on mute.
Hi, Carl.
Who are you looking for?
Carl, you had your hands raised. Did you have a question?
I didn't have my hand raised. If I did, it was an accident.
Okay.
Sorry.
No worries.
Thanks, Carl.
All right. Another question typed in was, this is for Gary. Can you explain what is sponsor equity in a SPAC? How does that work? What's the difference between sponsor equity and other types of equity within SPAC?
Sure. It's a great question, and thanks for it. So sponsor equity is basically the equity that you get for creating the SPAC vehicle, launching it, and ultimately realizing a successful business combination. When someone launches a SPAC vehicle, you put up a certain amount of risk capital. Generally, it's not immaterial, and it is binary in nature. And so you raise a capital, you launch the SPAC vehicle through an IPO, and then you generally have 2 years to consummate a business combination. And if you consummate the business combination within that successfully within a 2-year time frame, then that equity can translate into material value. If you do not, and that's where the binary nature comes in. It manifests into complete loss. Generally speaking, all SPAC sponsors start with post IPO 20% of the vehicle that you raise and a certain amount of warrants. And generally through the business combination, the construct of that equity, whether or not it's the warrants that you own or the equity that you own, changes through the business combination, often through negotiation. That is certainly how we treated it in our Clever Leaves transaction, and it creates alignment with both the target and public market shareholders. And I think you'll see more of that in the future. Hopefully that, and I will add, in the case of Clever Leaves, we generated we think the risk reward in SPACs are great as a SPAC founder, and that was certainly realized in what we executed through the Clever Leaves transaction, generating a very nice return on capital to date.
Thank you, Gary. That's especially relevant for some of our fund investors, because this type of economic breakdown is the exposure that they get specifically. George, we have another question for you. This is from a current investor. What are some of the lessons that you've learned from the past?
Wow, been doing this a long time. Good question. I've learned a lot. I guess maybe the most important one is in risk management. I think when people think about investing, they often think, well, how do you find great ideas? And the truth of the matter is that there are lots of great ideas out there. But I think you really distinguish yourself with good risk management. And it's hard, it's psychologically hard. It's been proven, and I've said this to a lot of investors in the past, so hopefully it doesn't sound like a broken record, but it's been proven that think of it as Pareto's principle, or the 80-20 rule, that most of your gains for any investor come from a small percentage of their positions, right? So 80% of your profit comes from under 20% of your positions. If you believe that maxim, and it is true, it's been proven that it is, then the corollary is that most of the time you're not going to make profit in positions. So you have to be able to get out of them quickly if they're not working or if something happens that goes against you. And that's really truly risk management. So it, up and down, the construct of building a portfolio, you've got to position things, with that in mind. You've got to, manage your leverage, manage your exposure, manage your risk with that in mind, and be ready to pivot when something doesn't work. Again, it's not easy to do, but it's probably, I think, one of the most important lessons I've learned, in decades of doing this.
Thank you, George. Thanks for sharing that with us. We've got that's a really good question. I think that should be something that we're constantly asking ourselves. Another question we have is for Gary. Can you tell us a little bit about what you are seeing currently in the SPAC space?
Sure. So I think it's a very interesting time. Again, I've been involved in this for a while, and we have as a firm for nearly 3 years. I think we've seen an unprecedented amount of activity in SPACs, both in SPAC IPOs and in SPAC M&A transactions. And I think what really set 2020 apart was the amount of successful SPAC M&A business combinations from the likes of companies that like a DraftKings or Virgin Galactic or very high profile sponsors, very high profile names, and often cases real business that that do have a true commercial need, and in my view should be public. I think those transactions and COVID driving rates lower has driven an unprecedented amount of IPO activity in Q4 and into Q1 of this year. We've seen a slowdown in IPO activity beginning in late March. I think that'll continue, but I do think what we will see with over 400 SPACs that are out there and a significant amount of IPOs that are in backlog, including ours, that we will see some very interesting M&A business combinations that will transact through SPACs, this year and continue over time. Tops, the baseball trading card or sports trading card company, and Confections, a 100-year-old brand transacting through a SPAC. A newer transaction or newer company, Blade, which is a helicopter aviation company. They're very well known in aviation circles, is transacting through a SPAC that's going to close in the next week or so. We're going to continue to see a lot of very interesting transactions occur through SPACs, where companies go public, raise a lot of money, and build great businesses. There will be failures, but I think there'll be more successes than failures. And I do expect that the SPAC, we will find that the SPAC product will continue to be a useful tool for companies to seek liquidity and go public in the future. So I'm pretty excited about it. I think we're continuing to be excited about it as a firm.
Yeah, it's a super exciting space, and we're continuing to look at that space. Speaking of new names, George, what are some of the new names entering the portfolio?
Well, we actually talked about a couple of them today. In the energy space, you have Chesapeake. It's a new post-reorg equity. Denbury, we talked about her as kind of a new name. But there are new ideas sort of almost every day. For instance, just earlier this week, Frontier Communications emerged from bankruptcy. It was one of the largest telecommunications firms that was in bankruptcy. We don't have that as a portfolio position right now, but it's something that we're looking at. It's post-reorg equity. It might be an opportunity for us in the future. We'll see. But day by day, there's it almost seems like it's as busy as we've ever been in terms of new ideas, new things to look at, public, private ideas. I think the focus really will be on post-reorg equities through the balance of this year, though, less on distressed debt, and probably a little less on pre-bankruptcy shorting. Although there's one company that's kind of a new idea, GTT. It looks like that equity will be canceled just within a few weeks as the company comes up with a plan of reorganization that's in the communication space. I think we'll probably see another blip in the default rate though. And this is sort of really hard to predict, where is it going to go quarter by quarter, but I wouldn't be surprised if you see a tick up in defaults, sometime between now and the fall. And maybe inflation will be one of the driving factors with causing additional defaults. There's a lot of debt outstanding, and as the government potentially takes away some of the stimulus measures, or as they run off, like the CARES Act, I think that as the water goes out with that, there'll be a number of over-levered companies that are swimming without bathing suits, and we'll see where they are.
There's a great question that just came in, and it's related to the SPAC activity. So this is for both George and for Gary. Will some of the holdings in the domestic and offshore funds be candidates for your SPAC activities, your SPAC practice?
I'll talk about that. Gary, you can chime in too if you want. Just by the way, in case people don't know, the holdings in the offshore and the domestic funds are the same. It's a master feeder structure. So there's really one fund that has the two feeders, and the feeders are really set up depending on where the investor is based, whether they're offshore investors or tax-exempt investors or US domestic investors. That's the purpose for that structure as a master feeder structure. But the answer in short is no. We're not looking to use the SPAC to buy something that we have in our portfolio. Gary, feel free to chime in. I don't know if there's much
No, I
more to say about
think
it.
I think you got it. Thank you.
Great. So back to kind of the SPAC space. Gary, we've got people, actually, this is a question that's been repeatedly asked, which is how did we choose Cleverleaves for the combination, and why was it Cleverleaves? And why weren't others selected?
Sure. So it's a great question. I think the answer was both company or theme specific and situation specific, which I think marries very well with us, and our strategy and theme as a firm. On the company side, we really hadn't seen anything like this before. We're a company of production scale, again, top 5 in terms of cultivation on the planet, that has unit economics that are 9 times better than anyone else of equivalent scale, which are predominantly the Canadian operators. If you play that forward, that would suggest the company should drive market share in the markets that it chooses to go after over time. They had $125 million of invested capital in the business. They had a very strong management team. And again, you have very high barriers to entry markets. These are pharmaceutical only open markets. So we're talking about Germany, Australia, Israel, Brazil, Mexico, I think is pending. And it is very difficult to duplicate both the footprint and the approach and strategies to what this company does. The company had the opportunity, this gets into the situation specific side. The company had the opportunity in 2019 to go public, regular way at a $750 million pre-money valuation. They had raised a lot of money, probably one of the largest funded private cannabis companies in the US with its management team in the US. And late in 2019, they decided not to go public, by the way. Later in 2019 and well in 2020, it became incredibly difficult to raise money. The company is growing, but it's also investing in its business, and so it is burning through cash. And they had limited liquidity options, and that gave us, frankly, leverage. And so whereas a company could have gone public at, say, $750 million pre-money, we had an opportunity to transact at $205 million pre-money. It was a meaningful down round to the prior private investment. It was less than half. And so we, in our view, we gave public market investors the opportunity to pursue a transaction on a fantastic risk reward basis that we think can generate meaningful multiples, returns on capital, returns on equity over time. in excess of other opportunities that we had foreseen on a risk-adjusted basis. And I think that was those are the key drivers for the selection. Hopefully that answered the question, Angela.
It does. Thank you. That was good. Thank you so much. We've got one final question. George, how do you think about key man risk?
That's a good question. Thanks for it. This is important to me, and we've been thinking about it more recently with COVID. Obviously, like most people probably have. It's important to me not just because I founded the firm, but also because I'm the biggest investor in the fund. But obviously, it's important for all the institutional investors and private family office investors with our fund as well. So the way our fund's key man risk provisions work is they work in concert with my estate plan. At the firm level, we have a life insurance policy that the firm bought that pays out in the event of my death. We also have independent directors at our fund. There are 3 directors. I'm one of them. There are 2 independent directors who can make decisions. And then specifically within the fund's governing documents, there are provisions that specifically address this. They allow investors to redeem in the event of key person event, or alternatively, if they like the team and we like our team, we hope that investors get to know our team and would think about them as long-term investors in the fund and long-term operators of this business too. But if our investors like the team and like the plan at that point, they can also vote to stay with the existing team, even though there's a key man event. So there's a lot more detail about that, actually, again, in our DTQ, as well as our fund documents if people want to take a closer look. But we think we have a good plan in the event something happens for a firm of our size and with our operations. Angela, I think you're muted if you're talking.
We're at the end of our presentation. On behalf of all of us at Schultz Asset Management, thank you so much for your time. We are grateful for our partners and our investors who have been with us for so many years. We are also excited to celebrate so many milestones together. Hopefully, we can see each other in person very soon. For more information on anything you've heard, please feel free to reach out to us at investorrelations@samco.net. I'm Angela Louie. This is George Schultz and Gary Julian, and we wish you the very best in your investing. Bye-bye.
Bye. Thank you.